You've mastered the basics of saving and investing. Now it's time to play 3D chess with some creative tax planning strategies. I'm going to be counting down the top 5 advanced tax planning strategies you need to consider. Which ones are you already doing? Which ones should you be doing? Got that and more coming up. Tax planning is all about the proactive, opportunistic work of paying the least amount of tax over your lifetime, if not multiple lifetimes. Sometimes this could be paying more tax today at very low brackets so that you don't have to pay the tax out there in the future, but all of it, a career's worth or decades worth of creative, proactive tax planning can add up to thousands of dollars, if not tens of thousands of dollars of tax savings. As a certified financial planner, tax planning is one of the 6 areas of your financial life. Again, it's the proactive work. Tax preparation, by the way, that's the reactive work. Getting the right number in the right box all before April 15. Yeah, that's necessary, but that's not planning. Planning's the creative work. And we do a lot of creative tax planning with our clients from very basic, like deciding, well, should you be contributing pre-tax or Roth as you're saving up for your retirement, to very, very complex strategies that could include selling a property, selling a business, and those sorts of things. Today, I want to focus on the top 5 advanced, so more on the complicated end of the spectrum, top 5 advanced tax planning strategies that you need to be considering or potentially implementing with the work of your certified financial planner. Coming up with the list was hard. There's a lot of tax planning strategies out there, so I'm curious what you think of my list, whether you would reorder them or whether there's some that you would say, oh, this would definitely make my top 5. I want to hear from you. Leave those comments below. All right, coming in at number 5. Number 5 is the donor advised fund. That's right, the donor advised fund. If you are charitably inclined, whether you're just giving to the church or whether there's other 501c3s that you care about and support, the donor advised fund is like setting up your own mini foundation, where as you make contributions to your donor advised fund, you get the tax deduction in the year that you make the donation. But then you have significant flexibility as to when and to whom you release those funds from your donor advised fund to the end charity. While they're in the donor advised fund, you can invest them differently. So there's different growth profiles, gives you a lot of flexibility. What I love about it, and why would I call it, why would it make the list, even though it's number 5? Well, because you can both optimize your tax deduction, but you also could avoid capital gains taxes. That's right. So it's tax deduction and capital gain elimination. How? Well, if you've got dollars that are invested outside of a tax shelter, outside of an IRA, a Roth IRA, and you've also got some cash that you say, yeah, on a monthly basis, I'm giving to the church, or I want to make a year-end donation, something like that. You could make a year-end donation with that cash. Okay, you get the tax deduction. Or you could take some of your investments that have appreciated in value, and instead of selling them and having a capital gain, you could donate those dollars, those shares to your donor advised fund. You get the deduction on the market value, okay? And then inside your donor advised fund, when you sell it, there's no tax on the capital gains because it's within a charitable account and there's no taxes. It's a tax-free account. Then you can use the dollars, the cash that you were going to donate to the church or to the charity, and invest those back into the same investments, and therefore stepping up your cost basis. It's a 2-pronged approach. Optimizing the tax deduction, eliminating the capital gains tax. Number 5 on my list, the donor advised fund. Number 4, and this is where I'm going to start taking some heat. It's the Roth conversion. And you might say, it's not an advanced tax planning strategy. I know, but in some instances it can be. Each and every year, you've got to take a look and say, is this the year I should do a Roth conversion? Just made a video about this. And yes, no matter your financial complexity, you need to be asking this question. Should I be doing a Roth conversion this year or not? However, the reason why I would have it on the list, even though number 4, the reason why I would have it on the list is there are some creative and advanced things that you can do with Roth conversions. It helps you avoid the headache of future required minimum distributions or the surcharges on your Medicare Part B and Part D, known as IRMA, income-related monthly adjustment amount. So creatively planning with a Roth conversion so that you fill up certain tax brackets or fill up certain years going right up to the edge of the income related monthly adjustment amount threshold for Medicare, or to a phase out for a given tax deduction or tax credit. You can get creative if you get precise with your Roth conversions, and it can be a simple strategy that's done in a very advanced way to parlay the tax benefits. Right along with the Roth conversion, coming in number 3 on the list is the Backdoor Roth IRA contribution. The Backdoor Roth IRA contribution. This makes sense for high wage earners if your modified adjusted gross income exceeds the income threshold where you can't make a Roth IRA contribution directly. Okay, if you make too much between your wages and other income that you've got coming in, maybe you own a business, maybe you've got some rental income, maybe you've got dividends, capital gains, that sort of thing, and your income exceeds the limit that you can see here on the screen, so that you could make a contribution directly to your Roth IRA, instead doing the backdoor Roth where you contribute to a traditional IRA, but you don't deduct it. It's after-tax dollars because you're phased out of contributing pre-tax as well. And then you do a conversion. It's a two-step. You convert that after-tax money over to the Roth side. It's number 3. It is an advanced strategy, but the reason why it's not higher on the list is there's actually a very, very big gotcha, and that is if you have any pre-tax money in another IRA, it really limits the benefit of doing the backdoor Roth. This is one of the circumstances where the IRS views all IRAs as one IRAs. You wouldn't be able to say, well, I've got my old 401k that I've rolled over, and now it's a pre-tax traditional IRA. I've got that over here. I'll open up a new IRA and contribute after tax, and I'll just convert that one. I mean, you could do that, but the amount of taxes that you would pay, it's going to be based pro rata, not just on the after-tax money, but on all of your IRAs. What proportion is pre-tax, what is Roth? So that's the backdoor Roth. It makes the list number 3. If the circumstances fit for you, work with your certified financial planner, can make a lot of sense and can help you build up a lot into that Roth side or tax-free side of your balance sheet. Coming in number 2 on my list is the Shoeboxing HSA. The HSA, and using the shoebox method, I'm going to get some criticism for this one as well, because I know not everyone has access to a health savings account. You need to have a qualifying high deductible health plan. If you have that, then you're able to contribute to an HSA. But if you don't, then you're not able to. So I can already feel the pressure from you saying, that wouldn't even be on the list. No. So I like it, okay? Here's why it is on the list. It's because it's the only thing. It's the only tax strategy I know of that allows the trifecta of tax benefits. Pre-tax in, tax-sheltered growth, pre-tax out. In that light, it's better than the Roth. It's better than pre-tax. It's better than the Roth. It's a tax deduction on the way in, tax sheltered while you're investing it, and tax-free on the way out. So it's got to make the list. And shoeboxing the HSA allows you to compound these benefits because you max out your HSA contribution, maximizing the deduction today. Then you have cash on the side. So as out-of-pocket medical expenses come up, you've got cash to manage those expenses, and you hang on to those receipts. Because you've got that cash there to manage the short-term expenses, that now means your HSA is long-term. You invest those dollars riding through the ups and downs of the stock market, but over time, compound growth. So your HSA is even larger, significantly larger than it would otherwise be. And then when you get to retirement, you've got a shoebox full of these receipts, these IOUs that you can reimburse yourself tax-free from your HSA, and of course, continue to use your HSA for qualifying medical expenses in retirement. It's number 2 on my list. Does it make sense for you? Work with your CFP on that. And then number 1, coming in at number 1, my top advanced tax planning strategy that you need to consider is the Mega Backdoor Roth IRA. And why is this on the list, and why is it number 1? Because it truly is mega. It doesn't apply to everyone. You need to have a 401k, an eligible 401k that not only allows pre-tax and Roth contribution, it needs to allow after-tax contributions. And that's where the mega comes in. Most people view your contribution limits to your 401k as the $23,500. And that's the limit for 2025, the year I'm recording this. And so most people say, well, that's the contribution limit. But there's actually a $415 limit, an overarching contribution limit that includes both your contribution, company match, and accounts for all of your various employer-sponsored retirement plans. And for 2025, that's $70,000 plus catch-up contributions if you're age 50 or older. So that's where the mega comes in. You can, over and above your pre-tax or Roth contributions, you can contribute up to that $70,000 limit. You've got to take into account company match or profit share or other contributions. You don't want to exceed that limit, but you can contribute, $10,000, $15,000, $20,000, $25,000 after tax to your 401k above and beyond the pre-tax or Roth limit, and then do an in-plan conversion or an in-service withdrawal that you then convert over that after-tax dollars to your Roth IRA. And it's a mega way, a disproportionate amount of money that you can get growing tax-free for your financial future. So that's my top 5 list of advanced tax planning strategies. I'm sure I left some out. There's some right on the honorable mention list, but what do you think? What would you add to that list? How would you change the order? What did I miss? I want to hear from you. Leave those comments below, but more importantly, which of these strategies makes sense for your financial situation? Tax planning, that's the creative work, but it's got to be connected to the other 5 areas of your financial life. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. Right there you have it. Go on, take your next wise step in your financial life.